I don't want to play too much This Is Your Life, but this is your sports life maybe a little bit. 2011, you're a Penn alum. This little basketball team in Philadelphia comes up for sale. It's a couple $100 million. You buy it. Did you ever expect that you'd be sitting here today with the sports empire that you have?
Not my wildest dreams. Not my wildest dreams. I mean, the notion that I would own the Philadelphia 76ers, where I had gone to college, the New Jersey Devils, where my dad had grown up, and then obviously a whole lot of other, Crystal Palace in London, where I'd lived, and then obviously the Washington Commanders, where I spent my, I was 1 to 18 in Washington. I was 0 to 1 in Philly, and then I went back to Penn. So the notion I would own and really manage the two sports franchises that I'd grown up really passionate about was incredible. It's an incredible dream come true.
And so what did you see, other than, I believe you had been at Penn when the Sixers won a championship, is that right? Like, what did you see that was, from your investor perspective, that was compelling about sports then?
Yeah, so my personal journey was, obviously, I grew up with the Washington Commanders, the then Washington Commanders, but John Riggins, Joe Gibbs, 3 Super Bowls. And 1982, the Commanders won the Super Bowl. The then Redskins, everyone came out in the streets, and D.C. was a very divided city. I witnessed all that, and then went up to Penn and saw the Philadelphia 76ers win the NBA championship, and Philly was also a city that was kind of having trouble. So I witnessed everyone come out, 2 ticker tape parades in 1 year when I was 17 to 18 years old, and it really dawned on me that sports really unified communities. And then, started Apollo, and then obviously got to the opportunity to achieve financial success. The financial crisis happened, and the Sixers, we had heard the Sixers might be not in Comcast's long-term future. And I literally just called them and went back to my day job of doing what's called a corporate carve-out, and I was zigging when other people were zagging. It was just after the financial crisis. The NBA was in lockout.
Right.
The Sixers were losing $40 or $50 million a year. I paid $280 million for the Sixers. I put together a group. I called David Blitzer, my friend, and a friendly competitor from Blackstone, and we had, known each other, gone to Penn, and we put together a group to buy the Sixers. I was quite nervous about turning it around, but we took them from 27th in the league in revenue to 5th, and so that's now a profitable entity. And so the idea there was more of a passionate thing where I wanted to really lift the city, connect with the city, bring the Sixers back. Obviously, in business, which we're all used to, EBITDA, stock price, valuation, cash flow. In sports, it's about winning championships and creating memories, right? So that's why I originally got into sports. Obviously, the journey had started as more of a value-oriented journey, very similar to what I do at 26 North. The evolution is quite different.
Right.
As we go into the days today, we can talk about it, but obviously I just paid, at the time I paid $6 billion for the Commanders, and that's 60 times EBITDA. And my credentials as a value investor were shattered, I joke. But the sports has changed a lot in that journey.
Yeah.
We could talk about that if you'd like.
Yeah, so I think you led me exactly where I wanted to go, which was that $6 billion figure, you're right, doesn't look like a value when you pencil it out. And yet, if you read the headlines today, or in the past month or so on Bloomberg and elsewhere, Jeffrey Lurie, your NFC East rival and neighboring franchise with the Philadelphia Eagles, selling a stake reportedly at a valuation of $7.5 billion. I'm not that good at math, but that's 25% more than the valuation you paid. $10 billion is the number that Stephen Ross is talking about, again, reportedly, for the Dolphins and associated properties. That's a huge jump. What is driving these valuations, and how much higher can they go?
Right. So if you look at the evolution of sports content, right, particularly the big sports, the NFL and the NBA leading the way, there's a massive globalization of content because of the ability of people to stream content and watch it on their phone. So, in many cases, there are more people watching the Sixers in China than there are in Philly. And that's the case all over the world. And so you're seeing, and then live content, right? All of us have witnessed the Taylor Swift phenomena. And, obviously I just found out that the Angel Reese Caitlin Clark, audience was by far the biggest ever in the NBA. The NHL finals, massive audience. 42 million people watched the Dallas-Washington game this Thanksgiving. And so this ability to, become part of a community watching a team live win, that's really lifting sports content. And so you're seeing massive upward pressure on valuations as more and more eyeballs and more people really engage in it. And it's become very important to the media ecosystem. So if you think about the NFL, the Bills in 2013, $1.4 billion. Panthers, 4 years later, 2.3. Denver, a couple years ago, 4.6. Commanders, 6. I mean, that's been the arc. In the last decade, you had a 4X. I mean, obviously, it's rumored, or maybe be inked, that the Nets just sold a minority stake for $6 billion. And their Forbes value, which is how people kind of think about it, at least as a starting point, was was in the threes. So right. You see and that part of that is that the NBA deal, right, is rumored, and I don't want to get ahead of the league, but it's rumored and in the press that it's going to be more than 2x the last deal. So that'll take the NBA from a league that was making some cash flow and growing to a league that's making a lot more cash flow that's achieving substantial growth. So you have all that, plus you have, the entrance of private capital into sports. Mike Arangetti's on next, Ares, Arctos, Dial, and that's also expanding. You see, certainly some sovereign wealth funds owning teams in Washington. So increasingly, you're just seeing a lot of upward pressure, and it starts with, the communities themselves. There's been a breakdown of community, right? It used to be that we lived in small towns, everyone's moved to the city. So what are the things that really bring people together? And sports is really a unique proposition. It brings people together. So it's very exciting for me to be a part of it. And, look, I feel a great sense of obligation to win, right? And because I know what that does to a city.
Yeah.
Anyway.
So is there a ceiling at this point? I mean, where does it go from here? I mean, you're a very smart, successful investor. You have to look at this and at least pencil out where this could go.
Yeah, I think that you've seen pretty long-term trends of Forbes value and enterprise values going up in the 10 to 16% range. So if you look at the valuations over the last decade or so, or even over the last 20 years. I mean, again, people talk about my experience in deal making at Apollo and Lyondell and all these things, but at the end of the day, the Sixers, right? The Forbes value on the Sixers is, between $4 and $5 billion. So you think about the acquisition that we made there, it's an amazing deal for us, and that's all being driven by the media content increasing and these becoming entertainment businesses and not local event businesses. And I would expect that to continue. When you see, if the rumors about the NBA are true and it's going to double over the next, 8, 9, 10 years, obviously you can do the math. That's 10 to 15% growth rate TV. There's a little bit of leverage there. So you kind of you can pencil out. I mean, when we put together this group in the Commanders, we had to make our case, and you kind of pencil out low to mid-teens, right? And it's not a private equity return, but I really like it as part of my own portfolio because it's correlated. It doesn't really go up and down with the economy. A lot of it's driven by the growth in the streaming content and technology. It's a growth equity business almost, and then it goes. It's generally trending up. There's a scarcity value. Sports teams are obviously operating businesses, and they generate cash flow. Some of them don't. A lot of them do. But then it's also kind of a piece of art, right? There's only 30 or 20, depending on the league, or 32 of these franchises, and people want them, right? So at the end of the day, it's worth whatever someone will pay for it, right? So there's an element of a little bit of a Basquiat there or beachfront real estate. So you got to kind of think about all that. But all of it really says to me that it's going to go up. I mean, interest rates have gone up, right? So you would think that sports would go down, but it hasn't really slowed it down at all because the media growth has overwhelmed it.
And so with that in mind, you went to, put together this group for the Commanders, a fascinating group of people, Magic Johnson, your partner David Blitzer, and others, Mark Ein, who I believe was a childhood friend of yours.
Second grade friend.
And that's a good second grade friend to have, you.
Mitch Rails.
Yeah, there you go. So when you think about that, you know how hard it was to sort of circle all of that up. You are in an increasingly small number of people who can write that initial check and circle that up. Private equity is reportedly coming into the NFL. Private equity has been, institutional funds have been in the NBA. You've been a witness to that. What's the effect that institutional capital coming into a league like the NFL have?
So all that's going to have upward pressure on valuations because if you think about the NFL, so the NFL, in my opinion, generates a lot more cash flow than really any other league. And so it's one of this very small number of sports where you're not really using a multiple of revenue. You can also use a cap rate, right? There's enough cash. So the average NFL team makes, $100 million of cash flow, right? So there's a cap rate there. It's not a high cap rate, but I think that private equity coming in will obviously enlarge the capital base that's focused on investing in sports, institutional capital, and it'll just create upward pressure. What happened in the Commanders deal is that it was a $5 billion equity check. So even for someone like myself, that takes you from not only do you have to be in the Forbes 400, you have to be in the Forbes 40, right? There are only a very small number of families that can afford that. And so obviously the Waltons, I had bid on the Denver Broncos. The Waltons came and topped me, right? And I had to create a group and they didn't, right? And so the smaller and smaller, the bigger and bigger the size, the equity check was limiting more and more the size of the individuals that could do it. And I think the NFL is intelligently saying, well, let's take a look at that because even though we're incredibly scarce content and people want to be part of this, we need to open it up to allow for valuations to continue. So the constraining part of the Commanders deal, and the reason that we were able to get it, was that you didn't have a massive individual or family show up, and then no one else could raise the capital because the NFL rules are very restrictive on governance, on control, on exit. And so we had to round up a whole series of investors, some of the people that you mentioned that would trust us, that we would be good stewards for the franchise, that we would be good stewards for their capital. And raising $3 billion is a lot of work, right?
Right.
And so the fact that I had been in the investor community, managed capital, but also been in sports, made me uniquely positioned to raise that capital, and no one else could do it. So it wasn't the value that I paid, it was the ability to raise the capital that got that deal. And that kind of whole process, I think, has focused the NFL on, okay, hey, how do we make this a little bit easier on everyone?
Right. I want to pivot slightly because, and this is actually something that came up backstage when we were talking with Mike Garaghetti, who is, I'm sure you're going to hear this more from Shonali and him, a minority owner of the Orioles. He's in business with Cal Ripken. And I pointed out, you're also in business with Cal Ripken in youth sports. That, I would imagine, knowing a little bit about this crowd, that there are a lot of parents of young athletes in this crowd. Tell us about that business. What's the business case for youth sports? Because you and David Blitzer together, personally, have gone in a pretty big way there.
Yeah, so what we've done is we created this business, Unrivaled Sports, and we did it, for us it was like an economic project and a passion project because, all of us, obviously we are fortunate in this room and, we all love sports. I love sports. Sports changed my life. I was a college wrestler. If I hadn't gone through the experience of, having to go out there and literally be physically dominated by another human being, I probably wouldn't have worked as hard as I did in my youth and, turned my life around, and I've learned a lot from it.
You have wrestled Wall Street to the ground.
There we go. I love that. I'm going to use that. Look, I think we want the opportunity to have everyone's kids to be able to experience that no matter where they're coming from. So Unrivaled is a series of youth sports leagues, camps, It spans baseball with Cal Ripken and a series of other individuals, to Shaun White in adventure sports. Most recently, we're in flag football, which is obviously very exciting, and we touch over 1.3 million kids. And you've got the people in this room that can pay a lot of money, and people pay a lot of money to send their kids to get better at sports. If you're a youth baseball player, you can go to the Hall of Fame, Cooperstown Baseball, right, where we own the land and the fields. Like, that's an incredible experience for the summer, and people spend their whole year thinking about that, and it's expensive. But on the other hand, you can also invite people and teams and clubs that can't afford it. And so it's one of those unique things where it's incredibly profitable, but it's also incredibly good for the world and a positive thing. And so we're attracting all these incredible people to do it. It's growing like crazy. Andy Campion, who was the COO and the CFO of Nike, who had many, many other offers. This is a emerging company, but it's still pretty small. Said, no, I want to do this because this can be a massive company, and it sort of is hitting on what people want to spend their time doing and thinking about, particularly women's sports.
Yeah.
Which we can talk about, but it's a lot of the participants, certainly in flag football, are girls and women. And
so, what gives you see the landscape probably more holistically than almost anyone. You've got the EPL, you've got NFL, you've got, we've talked about all the different holdings you have. The valuation's going up. This is a great business. And yet, you're a smart investor. You're looking around the corner. What gives you pause? Like, what sort of worries you a little bit about this broader sports as an asset class market?
Yeah, I think if you think about sports, right, the big 5 or 6 sports, the NFL, the NBA, the Premier League, UEFA, so the Champions League, and then the NHL, those are all like global media businesses, right? They're not live entertainment businesses. I'd say the rest of the world, and those, the reason that people want to watch those sports, I mean, maybe Indian cricket, which I'm not as familiar with, the best players in the world come to those sports, and even the Premier League is even starting to, dwarf some of the other national leagues, right, because the media dollars are so big. So more and more of those sports are going to attract, the kind of global audiences and continue to grow. Obviously, in certain sports, you've seen live golf. You've seen, some nation states kind of try to come into those sports. I think it's pretty hard, to be honest with you. That would be one thing that we just have to keep our eye on. And the other thing would just be, obviously, anytime you see, as a value investor, anytime you see substantial growth in valuation, you always kind of look at that. But I do think I don't really see it slowing down. And for me personally, this is. These are long-term assets. They're going to be in our family hopefully for generations. My daughter's in the audience.
I was going to say your daughter's here. I saw the future.
It's really more of a long-term and passionate thing for our family where, our job is to win for the cities and create memories. And the financial part of it has been exceptional. And I do think it will keep going up. And I've been lucky to be early because the price is going up on all these sports, but I'm not really as focused, year in, year out on the valuations, other than intellectually and other than as I buy new things.
Right. Just have a couple minutes left. I would be delinquent in my duties if, in front of this crowd, I didn't ask how this is affecting your day job. Although it feels like you have about 6 day jobs. But you started this new firm, 26 North. In your sort of post-Apollo chapter, I have to think what you've done in sports has some impact, whether it's emotional or analytical or whatever it is. How do they inform each other, and specifically, how does sports inform 26 North?
Yeah, so 26 North has been a hugely exciting thing. Obviously, I left Apollo 31 years and took a year off. That didn't work for me. I don't like golf. I don't like tennis. I like to work. I like to create ecosystems of amazing people that are excellent. And then, my passion was always to be an investor, so I went back to it. And we created a big firm ecosystem against a middle market amount of capital, a lot of alignment. Most of my capital is in sports or 26 North, and then everyone who joins, we're getting amazing people. They're all leaving huge jobs to get paid a lot less cash and own, part of the investor returns, which is different. So it's at $22 billion now. I think sports is incredibly in 20 months, which has been humbling to see the success of the company. But sports, I think sports is, in sports, it's not just about money, it's about impact. Like, how do you create memories, right? How do you make cities happy? So that stewardship, right, in finance, we're working to create, retirement savings for millions of beneficiaries. So they're similar, but I think what I do in sports, a lot of it is culture and people. Mm-hmm. And in finance, a lot of it is culture and people. This notion that it's not just about money, that alternatives is about creating a better world for millions of beneficiaries that are frontline workers, teachers, firemen, that if you can kind of bring a little bit of that impact part of it into finance, you attract incredible talent, like making it about more than just money and making it about impact and really focusing on culture. I've learned a lot of that from sports. And so I brought a bunch of that over to 26 North. And what it does, it allows me to, obviously in investing, it's all about returns. Yeah. At the end of the day, you live and die by your numbers, but you create those numbers by having great people. And so having this impact part and this kind of greater vision, I think, gets us great talent.